Tim Regan, founder here at PrairieView Wealth Partners. It's our belief that our job is to help you to live your legacy with confidence. So one of the things we'd like to do today is take just a couple minutes and give you a brief update on where we see the financial markets. If you're familiar with us, our headquarters is here just south of Chicago. We're starting to turn more spring on a day like today, and we're getting ready for the Easter holiday. Looking forward to that, it makes me think about growth and excitement and anticipation. One of my favorite times of year. I really look forward to seeing things start to bloom and enjoy the summertime and maybe take a little bit of time to enjoy the pool and the kids and that kind of stuff. Hopefully you're experiencing something similar where you're at. In today's market, we're seeing similar things. What do I mean by that? We're seeing opportunities inside of the economic setting that are continuing to grow. Seeing an economic backdrop that is strong enough to have us warrant keeping our position strong in the equity markets. In addition to that, we're actually seeing volatility in the markets reduce. Because of volatility being reduced in the equity markets, we're actually adding equity positions to our portfolios. If you're somebody that has your money actively managed by us, know that we will be actively managing those portfolios and increasing some equity exposure as we anticipate the markets being somewhat kind to us through this time of year. In addition to that, you can expect to see, for the most part, from our perspective, markets that are going to maintain some stability when it comes to the balance between growth stocks and value stocks. You probably have seen in the news, or may have seen in the news, a lot of conversation around, is it time to get out of growth stocks? Typically what happens is growth stocks are considered those stocks that maybe don't have a lot of profitability. They might not have a lot of cash flow coming in, but they're anticipated in the future to be a really strong company. Companies that fall into that category might be a company such as Tesla. That's a company that everybody is aware of. It's a company that seems like, man, they've got a lot going for them. They're going to be a very large company. I guess technically they are a large company, but we're anticipating earnings, we're anticipating sales. Typically, companies such as that, when they're going through their startup periods or the periods of excessive growth, they don't have a lot of cash on hand. Therefore, it causes them to have to turn around and borrow money to maintain their operations and to continue to grow. Because of that, as we see interest rates start to inch up, the conversation starts to become, are growth stocks going to be able to continue to stay in business if they have to continue to borrow money? So therefore, there's a lot of conversation that starts to say, should you be getting out of growth and moving into value? Value would be something a little more stable, something that typically has profitability and is paying a dividend. Usually, there's a very cyclical nature where one or the other will outperform. In some situations, growth stocks are the place to be, in others, value is the place to be. Right now, from our perspective, there is not enough credence, if you will, in value alone to start shifting that conversation. We see growth stocks have taken a little bit of a hit here lately, and we're seeing interest rates that are starting to creep up. But the Federal Reserve has come out and said we're going to keep interest rates low for an extended period of time. Because of that, it's our opinion that it's not time to increase our exposure to value stocks. Now, we're looking at it. Obviously, we'll be nimble, ready to make a move if it needs to be. But at this point, if you hear that conversation, know that in your portfolio and the portfolios we're managing, we're not making that shift yet. Because of the things that we've seen that I mentioned at the outset, a stable economic conditions, because we're seeing balance sheets of companies really being fairly strong. What we mean by a balance sheet is that companies have the ability to continue to service their debt and they're not getting overextended. You combine that with our expectation that we're seeing volatility in the market start to subside, you can expect to see us go a little more overweight into equities in the coming days. Looking forward to continuing the conversation with you. As I said at the outset, our job here at PrairieView is to help you live your legacy with confidence. If you're already a client of ours, thank you. If you're not and you're looking for a place that can listen to you, give you good, solid, family-focused, faith-based advice, please give us a call or check out our website. Also want to give you a quick plug. You can look for an interactive webinar that will be coming up here in the next less than a month, where we're going to look at a handful of key topics. Things like where are interest rates going? Should you refinance your home? Where's the unemployment rate going? If you're unemployed, what should you be doing right now? Really some things that are crucial right now, especially pandemic related. We'll have a neat interactive session with that. Look for that and register if you've got the time. Again, thank you. We look forward to the next time we can talk, and be well.